Okay, right. Let's continue. So welcome to the lecture series again for FM. Now, we have today completed two topics, investment appraisal and working capital or short-term capital. So now we move to chapter number 3, which is about long-term capital. Okay, now long-term capital for companies, we have share capital, we have debt capital. So we split into two parts. Lecture 12 and 13, we look at share capital, and lecture 14, we look at debt capital. So for lecture 12, first we look at different sources of capital. Then we look at different methods of issuing shares, focusing on right issue. Now, various sources of long-term capital. Okay. For some general discussion question, we can have internal finance, we can have external finance. Internal finance means the company made profit, you pay out dividend, the balance is the retained earnings. So the retained earnings can be used to finance the business future operation. So retained earnings is internal finance. Okay, this is retained earnings. So a bit of comparison of the different source of finance can be tested. Yeah, so just go through this. External means you raise capital from outside the company. You raise new capital. So raise new capital can be equity, share, issue new shares, or debt, bond capital, or borrow money from bank loan, or bond capital. Okay. And debt capital, we can have short-term and long-term. Long-term debt are debt with maturity period more than 1 year. Short-term debt are debt with maturity period less than or equals to 1 year. Okay, so comparing the different source of capital. Yeah, so just go through some of these points here. Okay, so we will start our focus on share capital or equity capital. All right, now, okay, company need capital, need money, they will issue share to raise capital. So they issue shares, the investor buy the share and put money into the company. The investors are now the company shareholder. Yeah, the investor who buy company share, we call shareholder. Okay, there are many different methods of issuing shares. Some reading here for you. Okay, please go through them. Sometimes multiple choice question, they can ask you some of this. Yeah, so please go through all this. Okay, we focus on method of issuing shares. Okay, so I'm going to start from here. Methods of issuing new shares. Okay. There are a number of different methods of issuing shares. We have right issue. We have offer for sales. We have offer for tender, tendering basis. We have public issue. We have placing, also called private placement. Placing or private placement. Okay. Right, different method of issuing shares. We split them into two categories. We split like this. Okay, the difference is if the method of issue is right issue, then the new shares can only be offered to the existing shareholders. Yeah, right issues, the new shares are offered to the existing shareholders only. people outside the company cannot buy the new share. Okay. But all these other methods are targeted at outside investor. So after the issue, new investor will come into the company. So that's the difference. Yeah. Okay. So now, okay. Basic knowledge of share, I believe you know, when a company issues shares, it comes with control. If you buy share in a company, you have voting rights. You have some say, some control power in the company. So when the shares are issued to people outside the company, the control goes to people outside the company. So if it is existing shareholder, then the control will remain with the existing people. So that is one of the main reasons why companies prefer right issue. But the control company will stay with the same people. It doesn't go out. Okay. So one of the benefit of right issue is the control power remain with the existing shareholder. Yeah. Okay. Right. That's why company like to go for right issue. Yeah. So of all these method of issue, right issue will be one of the most important one in real life and also in exam. In exam, you need to know right issues in detail. The rest, just basic. Just be aware what are they, that's all. Yeah. So these four methods, just be aware what are they. There are notes at the handout later part. Okay. I will briefly run through that with you. We will focus right issue for most of the time in this video. Okay. Now, so we start for right issues. New shares to existing shareholder. Yeah. So one of the benefit of right issue is it will ensure the control of the company remain with the existing shareholder. Okay. So it does not dilute the control of the existing shareholder. So therefore, when a company make a right issue offer, they want the existing shareholders to buy the share. Yeah. So otherwise, they have to give to other people. So to encourage the existing shareholders to buy the share, the right issue is normally priced lower than the market price. Okay. So if the market price now is, say, for example, the market price now is $3, the right issue will be made at 250 lower. We say issue at discount to encourage them to buy. Issue at discount. Yeah, right issue is always issue at discount. Right, the existing shareholders will be attracted to buy. Okay, now, but market is always very sensitive to information. Yeah, if today's share price is $3 and suddenly the company say I want to issue at 250, issue at a lower price. Yeah, now this can create a little bit of market panic. So some investor may get panic and start to sell off the share, and therefore the share price can fall. Yeah. So okay, there's always a worry. Yeah. Okay. Even though the issue price is lower than market price, you attract the existing shareholders to buy, but there's a worry that after the right issue, the share price will fall. Then it can affect your wealth also. Okay. So therefore, there's one important question that we want to answer with right issue. Okay. Okay. That is the question. What is the effect of right issue on the existing shareholders' wealth? What is the effect of right issue on the existing shareholders' wealth? Okay. Now, shareholders' wealth. Your wealth in the company depends on the company share price. Okay, you buy a company share. If the share price increase, your wealth will increase. Yeah? If the share price drop, your wealth will fall. So share price, shareholders' wealth depends on share price. Okay, so you buy share in, say, Singapore Airline. So the Singapore Airline share price increase, your wealth will increase. Yeah. So when the question says look at shareholders' wealth, that means you look at share price. Okay, shareholders' wealth means share price. Yeah. Okay. Now, so what is the effect of right issue on existing shareholders' wealth? Okay. To answer this question, we need to look at some example, some value to compute. So we start from here. The current share price of shares in Woodlands is $3. A 1 for 5 right issue is made at 250. Okay, right issue at 250. This is the right issue price. So you see, 250 lower than $3 now. The issue at discount. Assume market price of share does not move in the period up to the subscription date. At what price will the rights be traded? And what is the theoretical ex-right price? Okay. Now, my objective is I want to answer this question. Okay. So to answer this question, first, there are two values we need to compute. First one is the theoretical ex-right price. Okay, the theoretical ex-right price. Okay. X means after. So this is the share price after the right issue. Okay, this is the share price after right issue. At strike price. In theory, of course, so it's called theoretical, because actual market price depend on the market supply demand. You cannot calculate that. So what we calculate is just in theory, it should be like this. The actual price may be different because supply demand. Okay. Okay, now this is how we do it. 1 for 5 right issue. Right issue always come in the standard proportion. So 1 for 5, 1 for 3. Okay, what does this mean? One new share for every 5 old share. You got 5 shares in the company, you can get 1. You got 10 shares, you can get 2. Yeah? So all the shareholders have the same deal, is fair to everyone. Okay? Now, that's how we find the ex-right price. Old, new. 5 old shares, we get 1 new. Okay? The share price now is $3. So that is 15. The new share issue price is 250. 250. Yeah. Okay. So that is 2.5. Okay. So after the right issues, 5 plus 1, 6. Okay. Here is 17.5. Yeah. So 17.5 for 6 unit. Every unit is 17.5 divided 6 is $2.92. This is the ex-right price. Okay. So the share price now is $3. After right issue, the share price fall to 292 in theory. So it go down. Okay. Why it go down? Because the new share is issued at the lower price. Yeah. So it go down because the new share is issued at discount. Okay. Okay, that's right price. First one. Next. Okay. Another value that we need to work out, the value of the right. Okay. The value of the right is the X right price minus the right issue price. Okay. X right price is $2.92. Yes. Right issue price it is $2.50. Yeah. So this is 42 cents for each right. Okay. Okay. So this is the value we want. Yeah. This is the value we want. Okay. What is this value of right? See, the right refer to the right of the existing shareholders to buy the share at the cheaper price. Okay. The shareholders can buy the share at a cheaper price. That is the right. One share is one right. Yeah. One share equals one right. Now, okay. These rights are transferable. So if I'm an existing shareholders, I have this right. But if I don't want to buy the share, I can actually give the right to another person. The rights can be transferred. Yeah? So you don't use the right, it is not lost. You can actually transfer. Okay. So which means if I'm a shareholder and I don't want to buy the share, I can actually sell my rights to another person. Transferable. Yeah. Okay. Now, okay. See, what is this 42 cents? As a shareholder, you buy the share at 250 cheaper price. The market price after right issue is 292. So immediately after right issue, you have made a profit of 42 cents because you buy at a cheaper price. Yeah. So this value of the right is actually the profit to the existing shareholder. So if I transfer my right to another person, that person will actually make this profit, but that is my profit. So I can actually sell him my rights for this profit. Yeah, I can sell him and I get my profit. Okay, so this 42 cents is therefore the sales value. You can actually transfer out your right at this price. Okay. Yeah, that is the meaning of value of right. Okay, you can sell off your right. If you don't use, you can sell it for 42 cents in theory. Okay, actual price, of course, depend on supply demand again. Okay, now with these two value, I can now come back to this question. What is the effect of right issue on the existing shareholders' wealth? Okay, so that brings us to second example. When right issue is announced, the shareholders can do three things. They have three choice. Either take up, means you buy the share. You don't want the share, but you sell the rights. Those rights can be transferred, or you simply don't do anything. Okay? Okay, now, so we want to look at effect of wealth. Mr. John has 1,000 shares in the company when the rights issue is announced. Show the effect on his wealth. Remember, effect on wealth means share price. So you are going to look at share price. Okay. Before. Okay, shall I start from here? Okay. Before the right issue. Mr. Jones, yeah, he has 1,000 shares. We want to compute his wealth. Wealth is share price. Before the right issue, share price is $3. Okay, before the right issue. So his wealth in the company is 3,000. Yes, 3,000. Yeah. Okay. After the right issue, okay, if he takes up the rights, so he buy the share. Yeah, takes up means he buy the share. Okay. How many shares he will have now? See, 145. Okay. Okay. 145. One new share for five old share. If he has 1,000 share, 1,000 divide 5, he can buy 200. Right? 145. So 1,000, he can buy 200. Yeah? 1,000 divide 5. So now he has 1,000. He add 200. After right issue, he will have 1,002. Yeah? He buy 200. Okay? The share price after right issue is $2.92 as right price. Okay, with a bit of rounding. Okay, so $2.92. So his wealth now become 3,005, with a bit of rounding. Okay. But the new share is not free. You must pay money for the new share. So you got to take out the payment. Okay. The new share must pay money. 200 share. As a shareholder, he will pay right issue price 250. So he pay 500. Yeah. So if you take up the payment, yeah, with a bit of rounding, okay, you find that they come back to the same. Same. Right? Okay. Now, if he take ups, if he sells the rights, okay, he's not interested in the share. So whatever right he has, he sell it off. Okay. Now, that means before right issue, he has 1,000 share. After right issue, is still the same 1,000. But he doesn't buy any new share. Yeah, so it's still the same. But after right issue, the share price dropped to 2.92. So that is his wealth in the company now. $2,920. Yeah. But he sell the rights. Okay. He sell the rights. He has 200 rights. So he's entitled to 200 new share. One share is one right. Yeah. So it's 200 rights. Every rights he can sell for, in theory, 42 cents. Okay. So he can sell for 42 cents. Okay, that's 84 with a bit of rounding. Okay, so you add up this, yeah, it is 3,004. You find that they are still the same. But if we choose to do nothing, if we keep very quiet, yeah, okay, possible, okay. Sometimes you don't know there's a right issue, okay. Because now it basically go by post and email. So they send you post, sometimes you don't even open the letter, or they send you email, like you go to your junk, you don't even know. So you may just miss the right issue. Okay, or you know there's right issue, but a lot of people don't know what to react. Some people don't even know what's the right issue. You don't have the knowledge. Okay, so you just simply keep quiet. Yeah. So okay, if you don't do anything, you will still have the same 1,000 share, but share price is $2.92 now. Okay, and you don't do anything, that is what you have. Yeah. Okay, so what will happen here? Okay. Before is 3,000, it becomes 292. Okay, therefore, he has actually suffered a loss, right? From 3,000 down to 2,920, lost 80. Okay, right. Yeah. So therefore, the conclusion we can draw from here. Okay. What is the effect of right issues on the existing shareholders' wealth? Unaffected by the right issue. It will remain the same. Yeah. It will remain the same as you can see the example, provided the shareholders react to the right issue. Either you take up the share or you sell the rights. If you keep quiet, you will lose money. Yeah, so the wealth will be unaffected by the right issue, but this one need to be extended. Yeah, okay, provided okay, either take up or sell the rights. Okay, you cannot keep quiet. If you keep quiet, you lose money. Yeah. Okay, that is right issue. So don't keep quiet. You will suffer loss. Okay. So these are the knowledge you must know on right issues. Yeah. Okay. Now, a bit of reading into this advantages and problems of right issue. Very common question. Okay. Now, we'll look at some question on right issue. This one. Socrates, a civil engineering company with 100 million 50 cents ordinary shares in issue. These shares are listed on stock exchange. On 1st of June, the company had market capitalization of 260 million. Now, okay, first, understand some basic here. Market capitalization is the total market value of the share. Is the share price in the market, yeah, the share price listed on the stock exchange times by how many shares the company has. Okay. This 50 cent here is the nominal value, or last time we call par value. Yeah, this is the value in the balance sheet. It's book value. So nominal value, par value, book value, they are all the same. Yeah. Okay. Now in finance, we are only concerned with market price. We are not really concerned with book value. Book value is not a cash flow, just for accounting purpose. Okay, so we will always ignore this. We will take this. Okay. On 2nd June, the company announced signing of a contract with an overseas government to build motorway. Financial analysts expect the contract to result in increased cash flow with MPV 20 million. In order to finance the contract, the company intends to make right issue after it has announced the signing of the contract. Key point, yeah? This would either be 1 for 5 right issue at $2.50 per share or 1 for 4 right issue at $2 per share. A. Calculate the market value of an ordinary share of the company immediately after the announcement of the new contract. Okay, first question. 1st of June, the market capitalization is 260 million. Yes, 260 million. Yeah. Okay. There's 100 million share. Therefore, one share market price, the market share price is 260. Yeah, this is share price. Okay. On the 2nd of June, the company announced the contract. This contract has positive MPV 20 million. Now, you learn in the first chapter, positive MPV increase company value, right? So you add. If negative, it will reduce the value. So this becomes 280. You still have 100 million share. So the share price increased to $2.80. Yeah, positive MPV, increase share price. Okay, positive MPV, increase share price. Okay, next. Calculate the value at which the right will be traded. For 145 right issue, 144 right issue. Okay, value of right, yeah? To get value of right, first I need to get the strike price. Okay. The theoretical strike price first. Okay. One for 5 right issue, 5 old shares, 1 new share. Okay. Old share, what is the share price now? Okay. The share price now, you have 260, you have 280, two different prices. Okay, here's where the timing is important. Okay, the question say, right issue after you announce the contract. Yeah. So after you announce the contract, the share price should be 280, right? So right issue is after this. Yeah. So the timing is important. Okay. So right issue is after you announce the contract. So 280. Okay. The new share issue price is issue price 250. $2.50. Okay. Yep. So 6 unit here, 16.5 here. 16.5 divide 6 unit is, this is the right price, yeah? Okay. And the value of the right is the right price minus the right issue price 250. So it's 25 cents. Okay. 25 cents. For 144 right issue, 144 right issue, 4 old shares, 1 new share. Share price now $2.80. The new share issue price 144, $2 per share. Okay, 144 is $2. 11.2. Yeah. Okay. 4 plus 1, 5. 13.2 divide 5. So the value of the right is the ex right price minus the right issue price, 64 cents. Done. Okay. Okay. Next question. We do one more. Okay. Next question. Mosam has a payout ordinary share capital of $2 million, represented by 4 million shares of 50 cents each. Earnings after tax in the most recent year, 750,000, of which 250,000 were distributed as dividend. The current PE ratios of these shares as reported in the press is 8 times. The company is planning a major investment that will cost 2,025,000. The necessary finance to be raised by right issue to existing shareholders at the price of 25 cents below current market price. Okay. You are required to calculate number one, the current market price. Now, the current market price is not given. You need to find. Okay. To find the current market price, you are given this PE ratios. PE ratios is share price divided by the earnings per share. That's why it's called PE. Yeah, PE. Okay. Okay. Share price divide earnings per share. Yeah. Okay. PE is 8 times. Okay. Let me put down the equation first. So you take the PE ratio times by the earnings per share that equals to share price. From PE ratio, we can find share price. This is something common in your FM exam. Okay, very common. We're going to apply this. Yeah, share price is PE ratio times by EPS. PE ratio is 8 times from the question. Earnings per share. Okay. Earnings per share is earnings or profit after tax divided by number of ordinary share. EPS, yeah? Profit after tax or earnings here. Number of ordinary share is 4 million. 4 million share. Okay, these are just my counting ratios. Yeah. Okay. So the share price is 150, right? 150. Okay. Okay. Two things. Number one, what does PE ratio tell us? PE ratios indicates how attractive is a company share to market investor. The attractiveness of the share to investor. Yeah. See, if the company share is very popular, a lot of people buy the share price will increase, right? So the share price increase, the PE increase. Okay. So if I compare two similar company, say I compare Shangri-La Hotel and say New World Hotel. Okay. So if Shangri-La Hotel has higher PE, means investor like the share of Shangri-La. Yeah? So the company with higher PE, the share are more attractive. So PE will indicate how attractive is a company share. Okay. Yeah. Profit after tax is given here. Okay. Sometimes you may need to work out by yourself. Okay. It is from the income statement, PBIT or operating profit. You pay interest, you get profit before tax, correct? Then you pay tax, you get profit after tax or earnings. Yeah. So profit after tax is this figure. Okay. So sometimes you may need to find that by yourself. Okay. Number two, the price of the right issue. Okay. The right issue price. Right issue price. 25 cents below current market price. Current market price is 150 here, minus 25 cents. So this is the right issue price. Okay. Number three. Okay. The number of shares to be issued. Okay. The purpose of the right issue is to raise this capital. Okay. I want the right issue to raise this capital to finance this investment. It's 2,025,000. I need to raise this money. Yeah. Okay. Now, if the question gives you issue cost, you add in. This question don't have. Yeah. If there is, you add in because the money that you raise must pay the issue cost. Issue cost, example is like the cost to prepare the prospectus, the stamp duty that you pay, yeah, the fee to the broker firm and the stock exchange, yeah, all the costs related to issuing shares. Okay, so if the issue cost you add in, every share will give us $1.25. Yeah. So okay. How many shares? Okay. Number four, theoretical strike price. Okay, theoretical at strike price. Okay, theoretical at strike price. See, we have 4 million shares now. So O is 4 million. This is what we have now. We are going to issue 1620 new shares. So we have 4 million now. I put here 4,000. Yeah. We want to issue 1620 new shares. The share price now is $1.50. The new share issue at $1.25. That is the extract price. Total here 5620. 8025 divide 5620. Yeah, 8025 divide 5620. This is the extract price. Done. Okay, that is right issue. Okay, beside right issues, other method of issuing shares, you just need some basic awareness. What are they? Yeah? Some basic discussion only. Okay. All these target at new investor outside the company. Yeah. Offer for sales, public issues. Okay. The difference between these two. Okay. I have all of them down here. So I do a bit of reading here. Do a bit of reading here. Okay. Yes. Offer for sales and public issue, they are similar that the shares are open to the public. The company will prepare prospectus, advertise in social media, in newspaper, okay, and it will invite the public to subscribe. Anyone, if you are interested to buy the share, you can fill up the subscription form, then you apply. It can be individual, it can be company. Okay, so everyone can apply, individual or company. Yeah. Okay. The only difference is offer for sales will go through an issue house. The underwriter, yeah, which is a bank, an investment bank. Okay. Whereas public issue does not go through an issue house. The company handle everything itself. So it's a little bit cheaper in that sense. Yeah. Just like you want to sell your house, you either go through an agent who handle everything for you, or you do it yourself, right? So issue house is like an agent to help the company to sell share. Okay. So when you call it offer for sales, you go through a bank. That's your issue house or an agent. If you call it public issue, the company do everything themselves. There's no agent. Okay. But of course, if you do everything yourself, you must be quite a big company that you know how to do everything. Issuing process is quite a complex process. Okay. So public issue, offer for sales are the same. They are all targeting at the large investor in the public. Can be individual, can be company. But offer for sales go through an issue house as an agent. Public issue does not. Yeah. Okay. Placing, or also called private placement. Now here is where it is not really open to public. Okay. This will go through a sponsoring merchant bank. So there's an issue house. It will go through an issue house. The bank will take the company share and make direct offer to some corporation. So it is not advertised to the public. The public sometimes don't know this is happening. Yeah. So they will make a direct offer. Okay. So for example, okay, if I was hotel and I want to issue new share through pricing, the merchant bank, the issue house will take my share and make direct offer to say Shangri-La Hotel or to Genting Group or to New World Group of hotels. Yeah. Okay. So if Shangri-La Hotel interested in my share, then they'll just buy over. So it's a direct offer. So it's called pricing. You price it directly to some company. Yeah. Okay. So to some selected institution. Okay, so it's a very cheap way because you are not dealing with the large public. It's a direct offer. That's called pricing. Okay. Uh, Offer for tender. Okay. In offer for tender, the company do not fix an issue price. You invite the buyer to tender. Just like you want to sell a product, you ask people to tender. Yeah. So it's like an option. Okay. So whoever subscribe the share will offer a price. So those who offer a higher price will have better chance to get the share. Okay. Yeah. So the potential shareholders will write in. Okay. And offer a price stating how many shares they want to tender and at what price. Yeah. Okay. So these are all the different methods of issuing. Okay. Now, finally, 11, 12, and actually in between there's one more. Okay. Bonus issue, stock split, and scrip dividend. These are three different methods of issuing new share. Bonus issue, scrip issue, stock split. They all result in increase in number of shares. So these are also method of issuing new shares. Yeah. Okay. So I put down here other methods. But there's no fund raised in the issue. So they are not considered source of finance because the company don't raise money. Okay. Other methods of issue, new shares being issued, but no capital is raised. So we don't call them source of finance. Yeah. Okay. One is bonus issue. Okay. You can do a bit of reading here. This table summarized up the three. Okay. So all no fund is raised. See? Fund raised no. Yeah. Okay. Bonus issue is to give free share to your existing shareholder. Yeah. So the purpose is normally to reward them. Okay. So you have a shareholder which is very talented. Let's say my company has a shareholder who is a minister in the government. So I want to keep this shareholder. I give him some free share. But he's minister, he's very useful. Yeah. So to reward the shareholder. Okay. Scrip dividend. Okay. Is give share to the shareholders in lieu of dividend. The share is to replace cash dividend. So in that sense, it's not really free. You don't pay cash dividend, you give the shareholder share. Yeah? So therefore, it is actually replacing dividend. Yeah? So scrip dividend or scrip issue. Yeah? So the share is to replace dividend payment. That's why if you look at the accounting entry, it's different. Bonus issue, you debit capital reserve, right? Scrip dividend, you debit revenue reserve. Because the law, the Company Act prohibits payment of dividend from capital reserve. You cannot pay dividend from capital reserve. So if you give share to replace dividend, it must be deducted from revenue reserve. Otherwise, company can bypass the law. Yeah. So if the share is to replace dividend, it must be debited from the revenue reserve. Okay. Okay. Stock split. Okay. This one happened when your share price hit very high. Yeah. If your share price, say your share price hit $20 per share. And when we buy share, we don't buy one unit. We got to buy in lot. So one lot, many country is $100, 100 unit. Many country, some country is 1,000 unit. So say one lot is 100 unit. So to buy one lot share, you will need $2,000. Yeah, it's quite a big money. So the higher the share price, it become more difficult to buy the share because you need quite high capital investment. So the company become less attractive when the share price becomes very high. Yeah, some company like Amazon, the share price is $100 over. Okay, so to reduce this problem, company will split the share. So if I take one share split into two, then immediately the share price drop to $10, right? It become a bit more marketable now. So when a company share price increase to very high level, some company may choose to split into two, split into four, so that the price per share drop, but the total value doesn't change. The total value is still the same, but the price per share drop. So it's to reduce the share price. Okay. So these three different issue method, they do result in number of share increase, but there's no capital raise, no money raise. Yeah, so we don't call them source of finance. Okay, right. So we have finished all the methods of issuing shares with a focus on right issue. The next video, we look at how we value share. Yeah, how we put a value into a share. Bye bye for now.